How many times have you changed your trading strategy this month? You lose 3 trades with SMC, so you switch to price action. You lose again. Next week, you're back to indicators. And the worst part, someone else is still making money with the exact strategy you just threw away. I did this for 2 years. Every switch felt like relief, like I had finally found the answer. That feeling was an illusion. It's not stupidity, it's biology. When we lose money, our brain triggers a threat response. It tells us the method is wrong. Natural reaction, wrong conclusion. After reviewing hundreds of my own losing trades, I found one truth that changed everything. The entry setup is only about 10% of a winning system. 10%. The other 90% is what this video is about. 90% of blown accounts have nothing to do with a bad strategy. They happen because a perfectly valid strategy was thrown into the wrong environment. The strategy didn't fail. The environment destroyed it. I'm going to show you 5 invisible factors that decide whether your strategy survives. I call them the 5 pillars of survival. Miss any one of them, and even the best entry signal won't save you. Get all 5 right, and even an average strategy can be profitable. Stop switching. Let's go deeper. Let's look at the charts. The first pillar, and the most critical one to check before anything else, is market regime. Every strategy was designed to work in one specific market condition. Drop it into the wrong one, and it will fail, every time, regardless of how clean the setup looks. Here is the mistake I see constantly. A trader learns a trend-following strategy, backtests it on a trending market, gets confident, and then the market shifts into a sideways range. They keep running the same strategy without adjusting. The signals still appear. The setups still look technically valid, but every breakout fails. Every structure break reverses. Not because the strategy is broken, because the environment is incompatible with it. This is what that trap looks like on the chart. You buy the breakout above resistance. Price pushes up 2 candles, then drops straight back into the range. You think it's noise. So you short the break below support. Price dips 1 candle, taps your stop, and spikes right back up. Stopped out from both directions in the same session. It felt like bad luck. It was not. That is exactly what a ranging market does to trend strategies. And it will keep doing it until you recognize the regime. A saltwater fish in a freshwater lake will die. Not because the fish is weak, because the environment is chemically incompatible with its biology. A trend strategy in a ranging market is exactly the same situation. The strategy is not broken, it simply cannot survive in that environment. Stop blaming the strategy. There are 3 states to identify. Bullish control, buyers consistently breaking previous highs, pullbacks get bought, the structure is clear. Bearish control, sellers breaking previous lows, bounces get sold, the direction is clear. And the one that kills most traders, the range. Neither side winning. Price sweeps a high, then sweeps a low, then comes back to the middle. Repeating. Endlessly. There is no direction. There is only the illusion of one. When the market is in that ranging, conflicted state, the correct move is usually nothing. Protecting capital when conditions are hostile is itself a form of profit. If you would have lost 3% in a bad ranging session and you stayed flat instead, you effectively made 3% worth of decisions without risking a single trade. Knowing when not to trade is a skill. It may be the most underrated one in all of trading. Pillar 2 is volatility. If regime tells you where the market is going, volatility tells you how aggressively it is getting there. A calm market and a volatile, panicking market require completely different responses, even when the direction is exactly the same. When I started trading, I had a rule I was proud of: 20 pips on every single trade, regardless of the pair, the session, or the news calendar. It felt systematic, disciplined, professional even. The problem was that I had confused consistency with correctness. I was consistently wrong. On a quiet day, the average candle might be 12 to 15 pips. A 20-pip stop gives your trade room. But on a volatile day, a major news release, the London Open, a period of macro uncertainty, The average candle can be 40, 50, even 80 pips. Your 20-pip stop is now less than half a single candle's range. The market breathes straight through it. One normal candle in volatile conditions takes you out, and then the market continues in exactly the direction you predicted. That is the most painful experience in trading. Not being wrong about direction. Being right about direction, entering at the correct zone, and watching the market stop you out by 3 pips before running 200 pips your way. If this has happened to you more than twice, it is not bad luck. It is a volatility problem. Your analysis was right. Your stop size was calibrated for the wrong market. The solution: match your stop to current volatility, not to a fixed pip number. Quiet market. Tighter stop is reasonable. Volatile market. You need a wider stop. But here's the rule that most traders miss. When you widen the stop, you reduce position size proportionally. Your actual dollar risk per trade stays exactly the same. Wider stop, smaller size, same risk. This is the only way to trade both low and high volatility environments without the volatile ones destroying your account. The ATR, average true range, measures the average size of recent candles over a set period. If the ATR reads 40 pips, a 20-pip stop is suicidal. It is literally half the average candle. A good rule: place your stop at least 1 to 1.5 ATR values away from entry, behind real structure or a meaningful zone. Only a move that genuinely invalidates your thesis takes you out, not just the market breathing. Pillar 3 is liquidity, and almost no trading course talks about this one. Most education teaches you how to find entries. Almost none of it teaches you whether those entries are actually executable at the price you think you are paying. Liquidity is the gap between your backtest profit and your live account reality. You run a backtest on a 1-minute chart, taking hundreds of scalping trades targeting 1 or 2 pips. The results look incredible, a smooth equity curve going straight up. You feel like you have found a money printing machine. But a backtest assumes you enter and exit at exactly the price on screen, with zero cost, with infinite liquidity. None of those things are true in live trading. When traders switch to real money, the equity curve looks completely different. Small winners become near break-even. Some become small losers. The strategy that printed profit for months in the backtest is slowly bleeding in live trading. Same chart, same setups, same rules. Something invisible is eating every trade before it can close in profit. Every time you enter a trade, you pay the spread, the gap between the buy and sell price. On major pairs during liquid sessions, it might be half a pip. On exotic pairs, low liquidity hours, or right after a news release, it can jump to 10 or 20 pips. Then there is slippage. Your order fills at a worse price than what you saw on screen because the market moved between your click and the broker's execution. Both costs are real. Both eat directly into every trade's profit. Do the math on a 2-pip scalp. You pay 1 pip of spread entering. Your target is 2 pips. Slippage costs half a pip on exit. Your actual realized profit, half a pip instead of 2. That is a 75% reduction from execution costs alone. The strategy was not wrong. The costs made it mathematically unworkable. Many strategies that look great in backtesting simply do not survive contact with real execution. The rule: the smaller your profit target, the larger the percentage of it disappears into spread and slippage. Scalping 1-minute charts for 1 or 2 pips means you are fighting execution costs on every single trade. On higher time frames, 15 minutes, 1 hour, 4 hours, your targets are naturally larger, and execution costs become a small fraction of the total move. Do not let the broker's spread be your biggest opponent. Pillar 4 is risk management. And I want to be precise because most traders think they understand this when they don't. Risk management is not about being cautious. It is about mathematical survival, staying in the game long enough for your edge to express itself across a meaningful sample of trades. Here is the trap. You find a strategy winning 70 or 80% of the time. You feel safe. The math is on your side. But win rate alone does not protect your account. A strategy with an 80% win rate and broken risk management will destroy an account faster than a 50% win rate strategy with solid sizing. Here is exactly why. Even an 80% win rate produces losing streaks. Over a 500 trade sample, you will hit stretches of 3, 4, even 5 consecutive losses multiple times. This is not a sign that your strategy broke. It is statistical noise. It is completely normal. Every professional trader on earth experiences losing streaks. The question is not whether it will happen. The question is whether your account survives it when it does. 3 specific behaviors turn a survivable losing streak into a fatal one. Revenge trading, taking unplanned trades to recover losses immediately. They are lower quality, taken emotionally, and compound losses instead of recovering them. Position doubling, increasing size after a loss to win back faster. Works occasionally, which makes it feel valid, but one extended streak with doubled positions wipes months of work in a session. And oversizing, risking 10 or 15% on a single trade because you are very confident. Confidence is not certainty. If you risk 1% per trade, you need 100 consecutive losses to blow your account, essentially impossible with any real edge. If you risk 10% per trade, 5 consecutive losses drops your account by 41%. That same losing streak at 1% risk is a 5% dip you recover from in a week. At 10%, it is a hole that breaks confidence before the account can recover. 1 or 2% per trade is not timidity. It is the math of staying alive. This is the mindset shift that separates professionals from amateurs. The stop loss comes before the entry. Professionals determine where the stop must be placed first, then calculate position size based on that distance and their risk tolerance. If the resulting risk is too large, they pass, no matter how good the setup looks. The entry is a detail. The stop is the foundation of every trade. The 5th pillar is psychology. I saved it for last not because it is least important. It may be the most important of all, but because it only becomes the deciding factor after the first 4 pillars are in place. Once regime, volatility, liquidity, and risk sizing are all correct, psychology becomes the only remaining variable, and it is entirely within your control. Imagine you did everything right. You identified the regime, you sized your stop for the volatility, you checked liquidity, you risked exactly 1%, you waited patiently for the setup. It appeared, it checked every single box on your plan, and then the market did something slightly unexpected. Your hand froze, or worse, you moved the stop, or you skipped the trade entirely. The setup was perfect, your execution was not. That is a psychology problem, and it lives entirely inside of you. 2 failure modes destroy otherwise solid traders. FOMO. You watch price move 30, 40 pips without you. The anxiety builds, and you enter without confirmation on a trade your own rules would have rejected. Anger after a loss. You take a clean loss on a valid setup, a completely normal event. But the emotional response makes you widen your next stop, or re-enter immediately, or size up to recover faster. Both feel logical in the moment. Both are driven by emotion. Both compound losses over time. Think of psychology as the final filter between your plan and your actual execution. Your plan was built when you were calm and objective, but between the plan and the trade sits your real-time emotional state, and that state can distort your execution without you even realizing it. Clean filter, execution, matches the plan. Distorted filter, the trade that goes in looks nothing like what you intended. That gap between plan and execution is where accounts are lost. And then the opposite problem, paralysis. You see a valid setup. Your plan says enter. But the questions start. What if there is news? What if this is a fake breakout? What if I am misreading the regime? You wait for one more candle, then one more. You add an indicator. By the time your doubt is satisfied, the trade has moved 50 pips without you. Overthinking feels like thoroughness. In trading, it is usually anxiety wearing the costume of analysis. Real discipline is not the absence of emotion. It is the ability to feel the FOMO and not act on it. To feel the anger after a loss, let it pass, and return to the plan. To feel the doubt before a valid entry, recognize it as anxiety rather than signal, and execute anyway. Discipline is choosing the rule over the feeling in the exact moment the feeling is loudest. No indicator can give you that. You build it through repetition, through honest review of your decisions, and through genuinely accepting that losses are part of the process, not proof that something is wrong. So the next time you take a few losses and feel the urge to throw everything out and start fresh with something new, stop. That urge is your brain trying to eliminate pain by eliminating the strategy. It is a biological reflex, not a logical conclusion. The strategy is almost never the problem. Instead, run through the 5 pillars as a diagnostic. Were you in the wrong regime? Was your stop sized for the wrong volatility? Did execution costs destroy a margin that was already too thin? Did poor risk sizing make a normal losing streak feel catastrophic? Or was the plan correct, but your psychology pulled you away at the critical moment? One of those 5 answers explains the loss. Find it, fix it, continue. Do not start over. The traders who eventually become consistently profitable are not the ones with the best entry signals. They are the ones who survived long enough to develop real judgment about regime, volatility, execution, risk, and themselves. Pick one method that makes logical sense to you, learn it deeply, apply it with solid risk management. Stay alive through the inevitable rough periods. Let probability work in your favor over a large enough sample. If this gave you a genuinely different lens for evaluating your trading, not a new signal to copy but a real diagnostic framework, drop a like. It helps the channel reach traders who need to hear this. And subscribe if you want more content that goes deeper than entry patterns. Trade safe, stay disciplined, and I will see you in the next video.